and those depreciate over 5 years. So now we're really speeding up how fast we're depreciating, and we're getting a lot of tax advantages in those 5 years.
Hey everyone, Justin Cooper with Pine Financial Group, where we work together so you succeed. You found our video on YouTube. We appreciate you. Go ahead and like the video. Please comment below if you like and want to interact with us on this. And of course, subscribe to our page. I'm here with Kevin Amolsch of Pine Financial Group, founder of Pine Financial Group. And today we want to talk to you about depreciation. And so Kevin, give us a little, like a high overview of what depreciation is and why us as investors need to understand depreciation.
Yeah, thanks, Justin. This is maybe a little bit of a dry topic, but it's so important because this is how you save on your tax dollars. You know, it's not how much money we make, it's how much we keep.
Absolutely.
So taxes, unfortunately, are a big part of keeping money in our pocket. And one of the big advantages to real estate investing is the tax advantages. And this is probably the biggest one of those. It's what we call a phantom income. So it's not really an actual expense that you're writing off, but it is lowering your income so you could pay less taxes. Depreciation in the eyes of the IRS on a piece of property it's called the useful life. The IRS calls it a useful life. It's how long will that asset be useful? And we know it's losing value every single year. And so we're allowed to write off whatever that value loss is every year on our personal tax returns. Now, you and I know over time, as long as it's maintained, properties will go up in value. There might be some dips, but over time, it's going to go up. The IRS doesn't look at it like that.
Right, exactly. So this is something that like a lot of investors don't pay as much attention to as they should. Usually a good CPA, maybe even just an online tax filing system, will help you capture your depreciation. But when it comes to diving deeper, you can really accelerate this depreciation. So just to kind of, for those of you not familiar with it, when you buy a car and you drive your car off the new lot, automatically we're talking about how the price goes down, right? It's not worth as much 5 seconds after you bought the car and took it off the lot. It's kind of the same thing, right? These assets will go down in value. They're depreciating in value. And so that's kind of what we're talking about. Right. The great thing is a car, the value goes down, it stays down. With real estate, the paper value in the IRS's eyes goes down, but the actual resale value hopefully maintains or goes up. But so diving a little deeper into the depreciation, if we want to maximize that paper loss, right? What are some of the things we can look at in our properties to depreciate and really maximize that?
Yes, let's talk about some of the tax advantages and how you use depreciation. And then let's come back to some of the risks around it. But just to be real clear, I think we did a good job of explaining it, but when you buy a house for, let's say, $100,000, that's your basis, right? Anything above that you sell it for is profits, capital gain. So depreciation, all we're doing is lowering our basis, so we're spreading out our capital gains. So you'll pay more taxes each year, but we get the tax benefits now when we depreciate, right? And something else to point out is, according to the IRS, you're required to depreciate your rental properties. So you can't choose to or not to, you have to do it. So how do we take the biggest advantage of this is the question that you asked me. Well, it kind of depends on your income level at the time. That would be the first question I would ask you, the viewer. If there's a really high income, then we want as much tax break as we possibly can get in that particular year. If we're expecting higher income over time, we maybe want to slow that down, the deduction, so that we can take it more over time. So the way we do this with depreciation is cost segregation. So what you're doing is you're breaking out different parts of your rental property and depreciating them at different speeds.
Right. So if we didn't pay attention to the different aspects of our property, what is the normal, if we just punch some numbers into some online tax filing, what would the property be depreciated at?
So first, you're not allowed to depreciate land. So you cannot, that's not going to go down in value.
So that 100,000.
The useful life on that is forever.
So that 100,000 would be broken out between the value of the land and the value of the actual property.
Right. So let's say you're taking a little single family house, you take out the 20,000 for the land value, let's say, and you have 80,000 left that you're going to depreciate. On a rental property, it's 27 and a half years.
27 and a half years.
And commercial is 39 years. So you would just divide that 80,000 by 27 and a half, and that's the deduction that you get on your personal return each and every year.
Awesome. And so let's say I don't plan on holding it that long, or I have this large income and I want to accelerate that. I want more than just 127.5
Yeah.
per year. How can we do that?
Yeah, this is a great topic here because you can really accelerate the depreciation. The way you do that is you enter it into your books instead of one purchase, one basis, the $100,000 purchase. You break out all the different components inside the house. Now, for me, when I was getting started, I would break out everything. The carpet's this much. I spent this much of the $100,000 went to carpet. This much went to drapes. This much went to appliances. Now that got a little crazy. So now I just break out all my personal property into one number. Personal property is carpets, drapes, appliances, and those depreciate over 5 years. So now we're really speeding up how fast we're depreciating, and we're getting a lot of tax advantages in those 5 years. Other components are like land improvements. So let's say your grass, for example, or the trees. Land improvements are over 15 years, so that's still quite a bit less than the 27.5.
And so that's a really good point, because the land improvements is not the value of the land. So
Right.
if we do landscaping, if we do the curb appeal and that type of stuff, we can actually depreciate that.
Yeah, and we depreciate it much faster. And we're on the honor system here in the U.S., so we could kind of say what we think we've spent on personal properties, on land improvements, and fixtures and furniture. Those depreciate a little bit slower. It's 7 years to depreciate those. So you could kind of just judge as long as all the numbers match to what you paid for the house.
Yeah, and so you can really dive deep. There's specific companies that just focus on this cost segregation. So typically they come in because there's a lot more, the numbers are much larger. They come in on commercial properties, but the same principles apply on residential. So if you're really interested in diving deep on this, if you have a large portfolio or you just want to better understand it, you can certainly reach out to some of those cost segregation folks to really wrap your head around it. Now, of course, Kevin and I are not CPAs, we're not
We didn't say
attorneys.
that. We should have said that.
So be sure to check with your tax professional to get really clear on your situation and how it'll best apply to you. But if you have any questions on hard money, on investing in real estate, Kevin and I and Pine Financial Group are always here to help. We'd love to talk to you. So please interact with us, get into the comments and leave us your thoughts, and find us anytime at pinefinancialgroup.com.